Hello everybody! August 2023 and the great SGX sale is back. 1 year ago, I started this channel and we were in the midst of a big REIT sell-off. And this year, the great Singapore SGX sale is back again and I went shopping again. It's an annual affair and it's pretty much a joke, I think. But this year, I've been warning about it for I don't know how long. I was pretty sure that the STI would fall quite dramatically, and this year did not surprise. If you look at the historical records of the STI index, in August, this stuff is pretty much always down. Starting from 2005, look at the track record. Down 3, down 4, down 6, blah blah blah, down 10 in 2011 because of the Euro crisis, and then down, 2015 down 9 because of the Chinese devaluation of the renminbi and so on and so forth. Down 6, this year down 4. Pretty much every year, the odds are in a fall in favor of a fall in the STI. It's always happening. It's just ridiculous. But of course, it's a good time to be shopping if you're looking to buy stuff at cheap levels with cash to spare. And I went shopping again. The first thing I did was, of course, to buy back the stuff, the REITs that sold earlier this year in the STI index. And the first thing that came to mind, I was looking forward to this quite dramatically actually. I was hoping and it really happened. I want to buy back FLCT that I sold previously, and I bought it back at 1.17. So I talked about it previously, and I sold all my REITs in the STI index. I didn't sell everything in the STI index, but I sold every REIT in the STI index that I can find at the expensive valuations. Subsequent to this, I actually bought back the stuff in MIT, and now this is the second REIT in the STI index that I'm buying back, and that's a FLCT. Not bad actually, because if you think about it, I sold FLCT at 1.35 in April this year. May this year, and after 3 months, whole thing just dumped off to 1.17. That's like I don't know, like 10% drop or something. It's ridiculous. So if you look at the third quarter updates, it's pretty good actually. The portfolio rental reversion is up around 10%, and on a average versus average basis, it's up to 1%. So I think the reversions are still very good. But I still have my doubts and my concerns though. One good mitigating factor is just a very low leverage of just 29% after they sold off the stuff at the Central Square. So the first concern I have, which still remains, is this chunk of a refi to happen in FY24, and now it looks like the Fed is not going to be cutting rates aggressively in 24. This is probably going to lead to a spike in the borrowing costs. The second concern that I had before was the performance of the business parks in UK. As you guys know, for loyal viewers of this channel would know, I'm not a big fan of the UK at all. After Brexit, I think the UK is just a shadow of itself. I think the UK government is still clinging on to dreams of it being a great and colonial power that it was in the past. I think this is very far from the truth. The UK is a declining power, and well, I'm not a big fan of the UK, especially with the Brexit happenings, high inflation, the need for the BOE to hike rates even further than the FOM, than the Fed, I think. If you look at the progress of the business parks in UK, the occupancy is still very low, right? It's just at 80%. But this Maxis business park is a bit of improvement from 66 to 80%. But nonetheless, this stuff is still very the occupancy is still far from what I like, so it's a bit of a concern. I also don't like the commercial part of their portfolio. As you know, commercial properties are suffering from rise in cap rates and the work from home phenomenon. And the commercial property in Singapore, in Alexandra Technology Park, is also going to see some vacancies from the move out of some tenants. So I'm a bit concerned about the commercial properties in the portfolio, which is the reason why I sold everything at 1.35 previously. But at the current price levels of 1.17, we're looking at the dividend yield of around 6%, which I think is quite well acceptable given the low leverage. So well, and given that I've been hoping to buy back cheaper, I didn't wait any further and just snapped everything up. The second thing I bought was Ascott Trust. This guy is not in the STI index, and I bought it at 96 cents. I was quite happy to buy it because I did not hold any Ascott Trust REIT units previously. The last time I bought this trust was more than 5 years ago, I think. And after the merger with AHT and so on and so forth, I just sold everything away, and I didn't bother to touch this stuff ever again. But this time around, it's different. Why? because they did a placement and a rights issue at the 1.025, and it was a disaster. Look at the total application, man, just 65%. The valid acceptances was just 37%. So it was just a complete disaster. I think at these levels, it's just pretty attractive actually. So I bought quite a fair bit of it of Ascott Trust, and I think I'm not a big fan of this trust, but I think it's gonna be a beneficiary of the recovery in the tourism and stuff. And look at what's happening for this trust. They've been diversifying to quite a big chunk of different asset classes, right? They have service residences, they have hotels, they have long stay rentals. Now they have PBSAs. So well, the sky's the limit for them to do acquisitions. The thing that I bought was venture. So this is also a bigger component of the SGX index. And look at the share price, man, 13.18. Look at the historical charts. This is pretty much back to where it was in 2017. So this share price movement has brought us back in time by 6 years. And look at the Google Finance is telling me that it's giving a dividend yield of 5.7%. I think there's a reason to be concerned about the company because of the slowdown in computers and manufacturing and the possibility of a recession and so on and so forth. But nonetheless, is this guy really as bad as what it was 6 years ago? I tend to think it is not very true. And anyway, since I don't have much of it in my portfolio, this guy is a cash rich, no debt, a bunch of cash yielding and which is going to benefit from the high interest rate environment. So well, I think it's not a bad thing to buy some and throw it into the books and collect the dividend, and that is what I did. The last thing that I bought was a bit of well, hesitant move on my behalf. That was a city development, and I bought it at 6.7. I thought very long and hard about it. In the meantime, the stupid share price just wobbled around 6.72 to 6.68 and 6.73 and so on and so forth. And I was wondering whether to buy it, and I just decided to buy it. Because the share price is looking really cheap. Look at the historical records, and this is maximum, right? Going back to 2005 or something. The current share price is 6.7, which was where I bought, and now the share price is below where I bought actually. This is pretty much back to where it was a global financial crisis. It's even below where it was in the 2020 sell-off, and then the 2015 China devaluation rubbish. It's back to where it was in the GFC already. And look at the current first half presentation for the results. The RNAV is $19. This is trading at 1/3 of the book, and I don't think CDL is a bad company at all. If you look at the gearing is not high, the reval of the properties, there's a lot of gems in the portfolio, especially for the hotel portfolio that they bought through the MNC company. So I think it's just way too cheap. The only bad thing is that the dividend yield is pretty low. At the current share price, I think it's less than 3%. But nonetheless, we shouldn't be so obsessed about dividends. This is a good company with very good assets, and if the management is serious about it, they can really unlock a lot of values. Which is why, well, since I don't have much of it in the first place, or in fact, I don't have any of it in the first place, I just bought a whole bunch of it and threw it into the books and collected dividends. So this is what I bought for this month, and I think September is still going to be a very volatile month because there's FOMC coming up, and I'm not sure if the Fed will hike. And now they're talking about maybe another hike in November. So I think this is not gonna end. I'll be looking to buy back a whole bunch of stuff in the SGX index if this continues to be weakness in the index performance, and I've spare cash to spare.